Hello and welcome back to All Things Money. I'm your host, David Blain. In the first segment, if you missed it, I talked a little bit about one of my favorite people to listen to, Jeremy Grantham, and he had a great quote on the ebb and flow of investment style. If you missed it, head on over to the web, www.dlblain.com. We'll have archived copies of the show posted, but in summary, it's worth repeating again that Jeremy states that 90% of what passes for brilliance or incompetence in investing is really the ebb and flow of different investment styles, growth versus value, foreign, domestic, and that typically investors become very impatient with a manager or mutual fund or their own investing if they underperform in a quarter or a year, and that typically what happens is that style is just out of favor. If they would just wait and allow the full 3 to 5 year cycle to go through, they would be well rewarded. So for example, since the recession, the risk manager, the conservative type portfolio that has managed the downturn very well has lagged behind, and that's just typical. If your risk managed portfolio going into 07, 08, 09 did extremely well, coming out of it, you're going to not do as well. Well, it's simply the ebb and flow of the cycles. Oh, and by the way, if you think that you can adequately time these cycles on a consistent basis, it's very difficult to do. Most people cannot do it. The better strategy is to find an investment style that works for you, whether it's fundamentally based, more technically based, more passive, more active, and stick with it. As long as it has a reasonable basis and has worked in the past under certain conditions, then you'd be far better off than continually switching styles. Okay, well, we'll move on from there. I wanted to talk a little bit about some things that are going on in the economy and the markets. I think it's very useful. There's been a lot of talk lately. Of course, here in the United States, we have our election coming up, which introduces a lot of uncertainty to the market. The market does not like uncertainty, but if you haven't noticed, the market has been in a pretty nice uptrend recently, but yet there's still a lot of folks calling for recession, imminent recession, and things like that. And as always, I like to look at the actual data. Now, one of the things that an official recession, the NBER, National Bureau of Economic Research Business Cycle Dating Committee, did you all get all that? The NBER Business Cycle Dating Committee is the official organization that says, yes, this was a recession, this was the beginning, this was the end, or no, it's not a recession. Now, we all know that there's a joke, it's a recession when your neighbor, or it's not a recession when your neighbor loses his job, and it is a recession when you lose yours. But anyway, there are some certain statistics that people look at, and although they're a little bit vague on the exact indicators that they use, there are 4 big ones that it's generally understood that they look at. Number 1 is industrial production. Number 2 is real income, excluding transfer payments, government transfer payments to people. Number 3 is employment, and number 4 is retail sales. And the weight of these 4 factors really goes into determining whether you're in a recession or not. And the industrial production simply measures, some people argue that it's less relevant today with lower manufacturing base in the United States, but it is still very relevant. In fact, the industrial manufacturing has been making a comeback recently. So this is designed to measure industrial production, capacity utilization, and how much our factories are producing. Real income measures on an inflation-adjusted basis the income of people, looking at things like wages and salaries and things like that adjusted for income. Of course, employment, everyone has heard of that. That's simply looking at the different employment ratios and how many people are working, how many people are looking for work, things like that. And then, of course, real retail sales, looking at the dollar volume, inflation-adjusted dollar volume of retail sales. And looking at these indicators gives you a very good picture of what's going on in the economy. You can see, if you graph them out, you can see different time periods where recessions were beginning. You can see the troughs in all these, and they typically follow each other pretty well. Some of them, depending on the recession, one of them may be deeper than others. So, for example, one recession may be a little bit harsher on employment and not as much on industrial production, but they all pretty much follow the same pattern. And my reason of bringing it up here today is to just look at all four of them are in uptrends, and they have been in uptrends since the trough in 2008. And so people that are, calling for, a second recession and things like that, they, who knows, they may in fact be correct, but if you look at the actual data from the Big Four, the primary indicators of recession, none of them are pointing down. We've had a little bit of a rollover in retail sales the past couple of months, meaning a little bit of a decline, but we see industrial production, taking off. We see real incomes rising. We do see, non-farm employment going up, although nowhere near where we need to be. But the fact of the matter is the trend is in the right direction. There's a lot of dispute over how to count it, and people discouraged from working aren't counted. I understand all these arguments, but the fact is it's not in a nosedive like it was in 2008, and we also see retail sales picking up. So these Big Four are definitely not pointing towards an imminent recession anytime soon. Well, that brings us to our second break. When we come back, we'll continue talking about the Big Four indicators for recession.